company can beat earnings one quarter and then crash 25% the very next quarter. That's exactly what just happened to IBM. On July 14th, IBM's stock got absolutely hammered, down more than 25% in a single trading day. That's not just bad, it's the worst one-day drop this company has seen in decades, worse than what many stocks experienced during Black Monday back in 1987. For a company that has been listed on the New York Stock Exchange since 1916, that is not your normal, oops, we missed by a penny kind of day. And here's the twist most people missed. Just one quarter earlier, in Q1 2026, IBM beat expectations and grew revenue 9% year over year. So how does a company go from beating the street to worst day in decades in 3 months? Stick around, because by the end of this video, you'll know exactly why Wall Street panicked and whether this crash is actually a buying opportunity or a trap. This video expands on my recent article for Barchart. The link to read it fully is in the description. If you're into stocks and markets, hit that like button and subscribe for more breakdowns like this. Let's get into it. The sell-off wasn't random. It was a direct reaction to the numbers and the CEO's own explanation. IBM reported $17.2 billion in revenue for its preliminary second quarter, reflecting a minor 1% growth year over year, with adjusted earnings per share landing at $2.93. These figures missed Wall Street's expectations of around $17.86 billion in revenue and an adjusted EPS of $3.01 to $3.02. While the difference was relatively small in percentage terms, it proved substantial enough to ignite panic selling. CEO Arvind Krishna didn't sugarcoat it either. He flat out admitted the company faltered, blaming clients pulling back spending, cybersecurity headaches, and big deals that slipped past the finish line. Corporate executives are not exactly famous for volunteering bad news. So when the CEO says the company failed to adapt quickly enough, you probably should not treat that as a casual footnote. This sell-off was so ugly, it sparked a new securities fraud investigation into whether IBM's management painted too rosy a picture of its deal pipeline. Now that's a credibility problem. Full results and the conference call drop on July 22nd at 5 p.m. Eastern Time. Until then, the market is pricing in worst-case assumptions. And that brings us to the real question. Was this merely one ugly quarter, or did IBM reveal a deeper weakness in its business model? Here's the thing that got buried under all the panic headlines. IBM just unveiled what it's calling the world's first sub-1 nanometer chip at the 0.7 nanometer node, cramming nearly 100 billion transistors onto something the size of your fingernail, promising up to 50% better performance or 70% less power use versus its older 2 nanometer chips. The company has also been building new power systems based on its Power 11 processors and tools designed for companies that want to run workloads across their own data centers and the cloud. On top of that, in June, IBM struck a strategic AI partnership with Alphabet's Google Cloud, building a dedicated group inside IBM Consulting to help clients run AI agents using Google's Gemini models tied into IBM's Watson X platform. And on security, IBM joined the OpenAI Daybreak Cyber Partner Program, using OpenAI models to hunt down software vulnerabilities automatically. So while the headlines scream crash, IBM's actually stacking chips, AI, and security bets for the next few years. The investment thesis depends on whether IBM can turn these assets into booked revenue. Great technology that does not convert into signed enterprise contracts is just a very expensive science project, and the market has already made it painfully clear that it wants results, not a guided tour of the lab. If this breakdown is useful so far, hit like and subscribe, because the next section is where I will show you exactly what Wall Street is saying and how you should approach the stock at these levels. The broader consensus from 22 analysts was a moderate buy, with an average target of $293 implying potential upside of about 40% from current levels. Wedbush analyst Dan Ives raised his IBM target from $320 to $350, while Barclays analyst Raimo Lenshaw began coverage with an overweight rating and a $350 target. But after the preliminary release, some firms moved fast. HSBC cut its target sharply to $191 and downgraded the stock. Oppenheimer downgraded IBM to perform from outperform, arguing that the bullish thesis would take longer to play out and that the stock could remain range-bound in the near term. Bank of America cut its price target from $330 to $280 while maintaining a buy recommendation, signaling that some analysts view the sell-off as an overreaction, but not a risk-free opportunity. Others are holding their powder or waiting to hear the full July 22nd update before adjusting. So the street's message is pretty clear. There may be value here, there may be upside, but IBM must earn back credibility one quarterly report at a time. My view: this looks more like a buyable dip than a broken long-term thesis, but I'm not rushing in size before the July 22nd full report. If you already own shares, the pain is real, but the core story probably didn't change in one quarter. New positions? I'd watch for stability into the earnings call and consider scaling in only on further weakness or post-call confirmation. The crossroads right now tilts positive for patient capital. Just size it appropriately and keep an eye on execution. This is not financial advice. Always do your own research before buying any stock. Past performance does not guarantee future results. If this helped, smash the like button, subscribe and turn on notifications. Drop a comment. What do you think about IBM? Is this a buying opportunity after the July 14th crash, or is Big Blue still searching for its next big thing? I will see you in the next one.